Good morning. It's Friday the 10th of October, and it is what is topping the agenda. With an hour to the open, European stocks are heading for a weakish start. The AI trade starting to lose momentum. We're watching FX as Japanese officials step up verbal intervention and the US steps in to buy the Argentinian peso. And the fallout from the First Brand's failure spreads, with European insurers looking like they could now face claims, Val.
Well, let's check in on these markets at the beginning of the hour. We are seeing a positive equity market so far this morning. S&P Futures up 0.1%, adding to their weekly gains. We have Euro below 116. This week has really been all about dollar strength. The Bloomberg Dollar Spot Index is having its best week since November 2024, since the U.S. election. U.S. 10-year yields essentially ending the week where we started, shall I say, at 4.12, just down 1 basis point on the session. The countdown to the opening trade starts right now.
Friday morning, good morning. We've got an hour to go until the opening trade. We are seeing maybe this rally that we've run with all week and a little longer than that beginning to run out of steam, Val. And there's a number of different factors behind this. But front and centre, basically, questions are being asked about the AI trade. Bubble, no bubble, and maybe some evidence mounting that the bubble side of that equation has some traction.
I thought it was funny in the session yesterday. We had NASDAQ down 0.7%, and I was getting things on my Twitter feed about the correction being here.
It's amazing.
But the S&P only ended down the session 0.3%. We're positive today, but the market is feeling very nervous about this tech trade all of a sudden. We had an update from Microsoft even overnight about their cloud business and the fact that they still have a lack of capacity when it comes to data centers, and that bottleneck is going to persist into 2026. So questions being asked, can they build this stuff fast enough? Do they have the money? Do they have the capital to build this stuff fast enough?
Yep.
And
just the concrete, when it's going to be profitable. Do they have the water? Do they have the power? Do they have the list goes on and on and on. But the question has been raging all week about kind of, are we in a bubble? Are we not in a bubble? And this is kind of this is the kind of dividing line for this market right now. And you can make the case on both sides, which is really interesting at the moment. And I think if you can make the case on both sides, does that give the kind of those that say it's not in a bubble the edge? Because I think if there was an obvious risk here, then maybe this rally would falter big time. But as you say, it's been kind of small moves have been getting people nervous, and it feels like it's really at the margin at the moment. We're dancing on a pinhead.
And the Microsoft thing is interesting. Yeah. The amount of CapEx that they have pledged and that they have done during this fiscal year is pretty monumental, but it still seems that no amount of spending can really get them the data center, the computing capacity that they need to get online for their customers. And these kind of questions, I think, are going to be pivotal for the next few months, because we are treading a very fine line of building all these data centers, having AI become profitable all at the same time in order for all of this to toe up. And I think the SoftBank thing overnight was another cause for concern.
SoftBank is taking a margin loan out on its ARM shares in order to get the money it wants to be able to invest in OpenAI. Again, the other theme that's run through this week has been the circularity. And there's a kind of building on kind of what we've built before, and whether or not actually what we've built before has solid foundations question being asked. And it's that kind of, with every turn, it's kind of, is this new? Is this kind of what is happening here that's driving valuations ever higher? And the SoftBank story just speaks to that.
And it's still all cyclical. Obviously, SoftBank invests in OpenAI. OpenAI uses computing power from Microsoft, uses their cloud business. If they're not able to deliver that, how is OpenAI going to deliver on their investments? And then how are they going to continue to borrow against their tech stocks, which they did to...
I think the real question is what happens when it unwinds? And you start to see, does it work in reverse? Do you start to see kind of the circularity there as well? Because it's positive on the way up, but it's very negative on the way down. And I think that's something else that the market is becoming nervous about.
Well, I guess maybe another thing that's the market's becoming nervous about is dollar shorts out there. They've really been in a lot of pain this week. The Bloomberg Dollar Spot Index is up over 1.2% in the last 5 sessions. It's best week since the U.S. election. And this has got a lot of problems written all over it. You can blame Japan, but you can also blame the fact we don't have a lot of U.S. U.S. data. It's really hard for the front end to rally, for yields to go lower if we don't have any more incremental data on the weakening labor market. So that's been one factor that's been driving the dollar on the strong side this week.
Are we looking this the wrong way around? Is this kind of weak, long dollar hand, long euro hands and long pound hands and long yen hands? Is that where the weakness is? Kind of the dollar is just kind of inching back against all of them, and you're just kind of wondering where the cracks are going to show up again in that narrative.
Well, again, it's funny that we see this such dollar strength happening alongside the strength in gold, because we've heard from many market players this week that have wanted to tie the rally in gold to dollar diversification, but it's not exactly tying up with the theme that we've felt this week. But we can, I guess, put a lot of blame on what's going on in Japan. The yen has had its worst week this year in over a year, essentially, and it's all in the back of the surprise election. The yen's weakened some 3.5%. And it's funny, we even heard from Takaichi in the last 24 hours saying warnings about currency weakness. But it's really not done a lot to turn around the yen. And you have to start thinking perhaps they may want that Bank of Japan hike at the end of October in order to shore up this yen weakness.
That's an interesting point, actually. But all of the kind of the kind of narratives that are running through the market at the moment, by the end of the week, are all being tested. Like the AI trade, what is happening there? This debasement trade around gold, that kind of narrative is being tested now. Do people really believe that? Does the evidence stack up on it? I think that's fascinating as well. The other kind of element of this we just need to mention briefly is Argentina. The US this is super rare. The US directly intervening into another country's FX market, and you wonder kind of what the path to success is for Scott Bessent to deliver on this, and whether or not ultimately this is something that the US can make stick. Is this just a short-term political interference story into another country's sort of process? I don't know. But this is super rare. And it goes back to a conversation you and I have been having for a long time, which is the US sees the FX channel as really important and sees FX intervention as part of the kind of the shtick at the moment that it's trying to deliver.
Exactly, and seemingly, you can maybe say that they are wanting to have an effect on the Argentinian elections. We know that the Peso slide all happened because Milei lost some local government elections back a month or so ago, and it's very interesting to maybe connect the dots that this is a politicalization of FX swap lines. Direct intervention from the U.S. Treasury is something that is rare. We've seen it 3 times since the 1990s. It's never happened in an EM market before. It's happened in the yen and in the euro. But this is the first time they've delved into an emerging market where an FX intervention like this has a sizable impact on the currency and on the nation's bonds as well.
Let's talk about another narrative that the market has run with for a long time, and that is that private credit is the way forward, and that private credit is going to deliver great returns, and that it's uncorrelated, and that you can basically diversify into this almost on a kind of risk-free basis. Everything's great. I just keep hearing this narrative. First Brands this week has really put that theory to the sword, I think.
We've heard...
And there's so much. You just go into the details here. It just gets so bad so quickly.
I urge everyone to read the big take that was out yesterday. Some fantastic reporting on this. But we've had now 3 firms talk about their exposure, one of which is being UBS O'Connor, the second of which being Jefferies a few days ago, saying they have a $715 million exposure. And then overnight, one of Japan's largest institutional investors claiming they have over $1 billion in exposure. And now, this Japanese investor is one of the largest players in CLOs. So you can see how this can perhaps really start to jostle the private credit markets on hearing about this. I mean, even what we reported in the big take, the creditors, a bankruptcy lawyer, essentially claiming that $2 billion has just vanished from their receivable account. So this seems like a story we're going to be keeping on for a while.
I think we're about to see some churn in the market for risk officers out there, potentially, because all of these big businesses, how have they not a 30% yield, and you're piling into this trade, and you're not worried about the risk, and you're not worried about the connections that are being made. Risk officers have got to be looking at this one and going, are there others out there? What else are we doing that looks fishy at this point? And you just very rarely are these isolated incidents. Yes, Greensill was an isolated incident. Yes, we've seen this in the past. Are there others out there? We're in a frothy market at the moment. Should we be surprised? Would we be surprised if others turned up and their similar business models and similar kind of risk events start to show up as the tide starts to maybe go out.
Yeah, and there's one more update on this story. We heard from the FT reporting that the Department of Justice has opened up a criminal investigation into First Brands. Now, you should note that this is not totally unusual for them to do so when it comes to a private company having issues like this. But again, the saga has now gone into at least the criminal spectrum.
There's also a story this morning talking about the fact that European insurers could be on the hook. They've written they've written business that could get them into trouble with this trade as well. Let's talk about what else we've got coming up on the show. Max Kentner's going to be here very shortly from HSBC, Chief Multi-Asset Strategist, still very bullish. Apparently business leaders had dinner last night with the Socialist Party in France. What came out of that? Fabrice Lesachet, MEDEF's Vice President, is going to be joining us. MEDEF, the business union in France. Hugh Gimber, JP Morgan Asset Management, Global Market Strategist, joining us as the markets open here in Europe. And James Reynolds, Goldman Sachs, co-head of Global Private Credit, is going to be joining us. That's going to be an interesting conversation as well as we talk about the implications of First Brands for the private credit business. We're also going to head to Riga for an interview with the ECB Governing Council member and Bank of Latvia Governor Martins Kazāks. That conversation coming up in the second hour of the programme.
Well, let's take a look at the events that we have on today's docket. At 10 a.m. UK time, we will hear the Nobel Peace Prize winner being announced out of Norway. And then later today, we do get a shred of data on the U.S. We have the University of Michigan Consumer Sentiment Survey. Along with that, we do get some updates on inflation expectations. Later this evening, we have the U.S. federal budget balance for the month of September. And then later, the self-imposed deadline for the new prime minister coming out of France. So we'll be looking for updates from Macron at the end of the session.
Apparently, they're pulling in staff to the BLS to try and get data out on CPI because it sets benchmarks in terms of Social Security payments and other factors in the United States. So they need to get that data delivered. We're going to get some data, folks. That's exciting. What else do you need to know this Friday morning? President Trump says he'll travel to Israel after the government there approved a deal for Hamas to release its remaining hostages in Gaza in exchange for more than 2,000 prisoners and detainees. Oil prices have moved lower on the news, but Hamas has called on mediators to, quote, assume their responsibilities after an Israeli attack left 4 people dead while the ceasefire was in effect. Japan's Sanae Takaichi is to meet her ruling coalition counterpart later today amid fears of a possible rupturing of the 26-year partnership that has been the bedrock for the nation's political stability. The focus will be on whether or not the ruling LDP will be able to convince its junior coalition partner over concerns over the past slush fund scandal that has been ripping through Japanese politics. And staying in politics, the French president is expected to name the next prime minister this evening in an attempt to form a new coalition. This after the resignation, of course, of Sébastien Lecornu earlier this week. Bloomberg understands some business leaders attended a dinner last night with the head of the Socialist Party, seen as a kingmaker in this process. The party wants a left-leaning premier now, open to an agenda of changes such as maybe getting rid of pension reform. We'll talk about that a little bit later on with MEDEF.
Well, coming up, we'll check on auto stocks after multiple car makers issued cautious outlooks this week, leading to the likes of Ferrari and Porsche to see sharp share drops. Plus, insurers and creditors are all on high alert. We're getting glimpses of the fallout from First Brands bankruptcy. We'll take a closer look. But up next, the yen and the dollar continue their move in different directions. We'll look into how that's impacting market positions. If you have any questions for your own for our guests, please send them to us on IB plus BBTV Go. This is Bloomberg.
European futures beginning to firm a little bit as we head towards the open. 42 minutes go until the opening trades. Does that momentum continue? There's a lot of factors, I think, to throw into the mix this morning. Val, what do you got?
Well, maybe some good news for market participants out there. We might get some data from the BLS before the end of the month. They did say that they are recalling staff to the office in order to put together the CPI report before month end. But the reason isn't to save the Fed or any traders out there. They need this calculation for Social Security payments for next year. It goes into their cost of living adjustments. But remember, Guy, month month end is on the 31st of October. The Fed decision is on the 29th. So let's hope they get to work and get to work quickly so we get this data point up before the Fed takes their next rate step. But broadly, in the absence of data, we have seen a lot of dollar strength this week. The Bloomberg Dollar Spot Index is having its best week since the U.S. election, since November 2024, up over 1% in the last 5 sessions. Some of this has to do with the lack of data. It's hard for the front end to rally any further if we don't get any more disappointing data on the labor market. But a lot of the catalyst for this really this week has come from the East, from Japan. We've seen the yen tumble 3.5% after the surprise election of Takaichi. Abenomics is back, and with it, a weakening yen on the back foot with it. Now, this is very interesting situation here, Guy, because perhaps it'll be the yen that really gets Takaichi to pull back her language and maybe shift her guidance for what they want the Bank of Japan to do. They did before say that they want the Bank of Japan to hold rates, but perhaps they could see the reason on why maybe the Bank of Japan needs to hike in order to stem the yen weakness. Guy?
Yeah, the dollar's kind of the other flip side of that trade, obviously, and dollar strength is something that people are beginning to become a little bit nervous about in terms of the implications. If we do see a dollar rally into year-end, if we continue to see this weakness that we're seeing in the yen, you could argue in the euro and plenty of other currencies as well. Max Kettner, Chief Multi-Asset Strategist at HSBC, joining us around the table this morning. Any of this throw you off the kind of the bullish track you've been on? There's a dollar rally potentially coming.
I mean, I'm always nervous when I'm on with you. We know that.
You should be.
Right? We know that. But apart from that, I'm fairly calm. No, I guess it's mostly really a yen and a euro story this week. It's not really a story of genuine dollar weakness, right? It's more like dollar strength.
Yeah.
It's not really dollar strength. It's more about the weakness of the others. Now, it depends whether that continues. I think, look, when you look at the Bank of Japan, the probability for an October hike, that's, I think, now even below 20%. You know, should that be 50? Yeah, probably, right? At least 50-50.
Yep.
If not even a bit higher, right? Because obviously, just because of the politics, it hasn't really affected the overall fundamentals yet, and certainly not thrown them upside down. And certainly when we look sort of 1 year out, I think maybe the front end has gone a bit too dovish now, and that, of course, then constrains the ability for the yen to weaken much further, and suddenly you talk about dollar weakness again.
OK, so you're not that worried about the dollar?
I'm not, no.
Are you worried about...
It's Friday morning, I'm not worried about anything.
He's had his porridge, he's good to go. And it wasn't too hot, it wasn't too cold, it was Goldilocks.
It was perfect, it was Goldilocks porridge.
Is absolutely spot on here with the Bloomberg porridge. Let's talk a little bit about the bubble, no bubble debate then in AI. Where do you sit on that? Because the debate is raging as to whether or not actually the AI trade has gone too far. Does that not cause you a little bit of concern?
It's amazing, actually, at the moment, that the higher we go, the more bearish people become, sort of, right? You would think the higher things go and the tighter credit spreads go, the more bullish people become and the more they get sucked in. But I can tell you, I mean, I've just been in the States for 2 weeks. We've barely had any questions around, hey, what's the next 10%, right? What is that going to be driven by? It's like AI is in a bubble, AI capex, like you're never going to monetize that.
Yep.
And then obviously we have the questions around the government shutdown. We have the Supreme Court decision next month you know, around tariffs. It's all these sorts of things.
Does that seem like, should people get more bullish when things go higher? There's a kind of
no, but you would think people get squeezed in.
It's crazy, exactly.
But you would think that people get one after the other get squeezed in.
Which makes you wonder about who's driving this. Is it institutional money? Maybe not, actually, because I'm assuming that's institutional questions that are coming to you. It's probably it's kind of others that are driving this story.
Yeah. I think what you are seeing clearly retail, and the other ones was systematics, right? Like at least on our measures. That's the thing. So when you look at risk parity, vol targets, CTAs, you know, about 4 months ago on our measures at least, that was comfortably below 5th percentile in terms of positioning. We're now scratching above 90th percentile. So it was a lot of it was trend following, vol target funds, sending vol down, buying even more, and a lot of it was retail. Actually institutional. We've got one measure of long only, right? So the real money investor community, the maximum long that they've had, or the maximum overweight in equities that they've had since the end of the rate hike cycle, right? Or since really the rate hike cycle began 3-4 years ago, the maximum they had there was about half the level that they had during the reopening in 2021. Then they cut into Liberation Day, and they've just increased now in August, September. And the level where we are now is about halfway where we were in January, February, which itself was only halfway where we were in 2021. So you can kind of tell you know, the sort of upside potential, just from a positioning perspective, there is when people are forced to be squeezed in.
Sounds like a reason to be bullish. But I want to ask you more about the momentum trades, because it does feel like in the lack of data, we are seeing these momentum trades continue. You know, whether it's gold, Bitcoin, tech stocks, as you mentioned. How are you piecing through what's going on with the U.S. economy in this black hole of data?
I mean, to be fair, it's not like we're just looking at these tier 1 data, and you know, I don't think investors are just going to look at you know, these 4 or 5 tier 1 data releases from a top-down perspective every month, and then job is done. You know, the good thing in this day and age is basically that we've got so much and so many alternative data points, higher frequency data points. Think, you know, things like credit card data, things like, you know, weekly retail sales from alternative providers. All of that stuff we can still look at, and it is being released. And frankly, you look at that stuff, that's still pretty solid. And if anything, has shown actually a re-acceleration since the end of Q2.
Well, the other thing that was solid yesterday, at least, was earnings. The first round of reports from Delta, from PepsiCo, even sales from Costco, all looking positive. We're buying expensive plane tickets, buying big goods from Costco, and drinking.
When you're saying we, is that you guys?
Americans, Americans, me here, yes. But do you think that the market is likely to over-harp on these earnings reports?
No.
Look at tech in 2 weeks.
No. Like, actually, I mean, you look at the earnings season, that is probably another upside catalyst, right? I've obviously done my very best to not answer Guy's question about an AI bubble. Maybe I shouldn't have said it, because now I'm being put on the spot. No, but look, when you look at earnings expectations from consensus to bottom-up consensus, actually what you are seeing when you exclude tech, earnings expectations sequentially from Q2 to Q3, they're down by 1%.
Yeah.
Right? So it's not like we're going into the earnings season and everyone's like, wow, like earnings are going to increase 10% quarter over quarter, and everyone is so bulled up. Effectively, when you look excluding tech and you look through the sectors, most sectors are expected to be either flat or down quarter over quarter.
Sure.
Right? Think financials next week, you know, are down like, I think 4.5% quarter over quarter.
Lisa Charlotte's got a great note on this, OK? So just in terms of the concentration over at Morgan Stanley. As it stands, 75% of the gains, 80% of the profits and 90% of the capex in the S&P are in AI's grip. Who cares about Costco trades on like a 52 multiple. I'm just going to point that one out as well, which is bonkers for a grocer, but an important grocer, according to Val. But it doesn't. None of it matters. AI has to deliver, and Microsoft's already signalling.
And what about what we've seen from First Brands? Does that?
Wow, you guys really have tried everything to make me bearish. Right? It's like, wow, like everything's coming from both sides. I don't even know where to look. This is great.
We've seen Blackstone shares underperform. Is there some worries growing in the private markets?
Not really. I think, you know, on the private market side, on the private debt side, to be honest, you can cut it both ways, right? You can either say, so the pushback I got on private markets, why it's such a bubble and it's the next big thing that's going to blow up, is, well, you know what, even they're trying to repackage it for retail money now, and there's all these flows and it's exuberant and everything's been swept higher. Now we see that not everything is being swept higher, and there actually is differentiation, and now people are saying, oh, there's cracks. I'm like, okay, so either it's exuberance and then it's bearish, or if there is differentiation, oh, now there's cracks. I'm like, so when is it ever bullish? So, you know, and look at that specific example. I mean, I keep seeing things like, oh, it's the Lehman moment. I mean, come on, it's 6 billion. Lehman was like 2 billion. No one knew the cross exposure across banks.
No.
Like, let's.
But it's an early example, maybe. Before Lehman, there were other things that came.
Sure, but like, let's be honest. In the last 5 years, there was about 100 early examples. We're going to talk, you know, I can come in every week.
I want to know what that jacket's made of. I'm assuming Teflon. Like nothing, nothing sticks.
Drinking the Kool-Aid over there.
To your point, does nothing matter? I don't think so, because if you look at the second quarter reporting season.
Yeah, you got to do this in 10 seconds.
10 seconds. Earnings growth expectations were 2.5. Realized was 8.5. So actually, the 493 are doing much better.
Max Kettner, thank you very much indeed. This is Bloomberg. Friday the 10th, good morning. This is what futures look like as we head towards the market open in 29 minutes' time. The bond market is opening up. France has been a big focus all week.
France has been a big focus all week with the political turmoil happening in Paris. We are set to hear by Macron's own self-imposed deadline a new prime minister sometime at the end of the close. But when we look at bond markets, France is looking pretty decent this morning, outperforming across the curve, down around 2 basis points in the French 10-year yield, outperforming even the Treasury rally at the moment. So it does seem like there is some positive sentiment headed into this risk event later tonight.
OK, let's focus on France. Let's talk about what we can expect at this risk event moment as we get a little bit later. So we're expecting a new prime minister. What political stripe is that new prime minister going to have, I think, is the key question. It appears that maybe actually, having tried the sort of centre-right and the centre, we're going to try maybe going a little bit left. How far left we go, I think, is going to be interesting. There was apparently a dinner last night. Some of the business leaders went to it with the socialists. The demands there are obviously for higher taxation. Let's get a sense of what is happening here in terms of this narrative and try and get an idea where we go next in France. Let's talk to Fabrice Lesachet, Vice President of France's biggest business lobby, MEDEF. Fabrice, apparently there was a dinner last night. Apparently business leaders went to it. Apparently there was talk of higher taxation. Is that what business in France is now expecting? Higher taxes?
Yes, sure. If the socialist takes over, it will be more tax, but not only more tax, it will be also some major reforms that will have a step back, like the pension reforms. The socialist wants to come back from 64 years to 62. And this is a major setback because this will cost the country around 15 billion euro a year. In a moment where we don't have the financial capability. You know that the French debt is 3,345 billion euro, and this year only deficit is more than 140 or 50 billion euro. So it's huge, and we non-stop add new spending to buy some political truce, and this is not the way to go. We need to be bold. It's time for real action. You see around us, Portugal is getting the tax down. Spain is having growth. Italy is doing the job on public spending. Poland is having growth. Even Germany with socialists is supporting their own company with 44 billion support package. Even Germany with socialists in the coalition. So France needs really to move on from that.
But it strikes me that the two choices that France now faces, though, is either early elections, parliamentary elections, which could cause instability, or higher taxation, which allows the socialists to get what they want and maybe a change in terms of what happens with the pension age. Aren't those the two choices at the moment? Give me another choice. Give me a third option, a third way of dealing with this problem. If we have political instability, and we've tried the right and the centre-right. So what's the other option?
First of all, our constitution provides, because it was well thought by General de Gaulle, it provides some safeguards to pass a budget in a kind of blank manner and might be the best things to have. That means that all budget from every minister and every ministry needs to be the same like last year's. Maybe that's the best way to fight at the end of the day against more spending. But we still have the possibility, we don't know, that we have the same kind of majority platforms that offer a name, but it was revoked or censored by the other parties before. So the same cause produced the same effect. That's why the presidents try to change and to provide the power to the socialists is a change. But at the end of the day, the socialists are very minor in this country. So it's also a problem because the other parties don't want the socialists. The fact is that France do not know how to do coalition. That's the problem. So until we have a clear majority in parliament, the stability will be complicated to reach. And if the stability comes at a high cost for the economy, the crisis will be more deep. So we need to have people that are bold and take the decision that we all know needs to be taken. Like all countries around us face the same difficulties, the same demographic gap, and they do it, and they do it in coalition. So we need to do the same.
Fabrice, I want to bring to light some recent odds on the betting market, on Polymarket. It now has a 10% chance that there's no prime minister by the end of this year. I mean, from what the betting markets are saying, they think that this indecision, this political instability is going to last for a substantial amount of time, perhaps well into next year. What do you think about those kind of odds?
But if you check CAC 40 is not so doing not so bad. The fact is that there is a disconnection between even the companies and the political reality. I would say, if I'm a bit provocative, that the Fed might be more important than the Prime Minister. But of course, it's a bit provocative just to say that there are other factors that underpin the performance of our companies, because our companies are across the globe. So the French market is only a part of it. And most of our companies are very healthy and are doing well in the last years and are doing well this year. So I would say that the instability is the most risky for the SME, the small and medium-sized companies. But for the CAC 40, it's a little bit less risky. For all of us, it's a problem because the interest rates are going up. So for households, for SMEs, to invest and to borrow money will cost more. So, of course, it's a blow. And the French growth this year is not great. It's 0.7, 0.8. We will see. But it's not great. And it's the two engines of growth, consumption and investments, are down.
Fabrice, I think maybe some market participants would say the reason why we haven't seen a bigger market reaction is because everyone is assuming that the ECB would step in if there is something that goes awry. You know, you could definitely look at what's going on in the French OAT market right now and see that Draghi's whatever it takes speech is still doing a lot of work even today. Do you believe that ECB backstop is there? And doesn't that kind of just create an odd incentive for France not to figure out its own problems?
But look, the Eurozone is like a building, you know. And our neighbors are tired that we let our garbage in front of the door. Every day we tell them, no, we will clean up the mess. Don't worry, we'll take them down. But every night we put them outside. So we cannot, the Eurozone is something where we are together, and we cannot be always the lame duck or the bad guys that don't do their homework. So it's not a solution to think that always someone will save us. We really need to take this seriously. The grades, the Moody's, the Standard & Poor's are coming again, and we'll have assessments. And this is not good for us. Okay. This is not good for our neighbor as well.
So not only is France leaving its garbage out, but it's also not doing its homework. This is not an A-grade student that we're talking about here. Fabrice, it's interesting. The Bank of Government of France has been on the radio this morning talking about how sick he is, basically, of the lack of a deal getting done to resolve the problems you've just laid out. He says his role, though, is still at the Bank of France. Would a technocratic government in France be better than a socialist government at this point?
We are not so much interested about the color. They can be pink, green, blue. We are interested about the content. Again, we are content-driven. And today what we hear about pension, about, last year they said that they will do a kind of special tax only for 1 year on big companies. And this special tax, corporate tax, is now moving for a second year in a row. Everything that is for a small period of time it becomes permanent here when it comes to tax issues. So it's content-driven, and what we need to do is to reduce spending. The problem is that the debate in France, many people think that the pro-business policy of Macron made that we don't have enough incomes, that the state lost incomes. And in fact, the problem is that we think, and it's factual as well, we have too much spending. So the people that think that we don't have too much income say we need to stop the pro-business policy. And the people like us, we say, no, guys, it's just the spending. You need to work more and cut the spending.
OK, you bring up Emmanuel Macron, and in the context of what you've just said, is there a danger that, therefore, this persists until we get presidential elections in 2027? Is that the problem here, that ultimately everybody is looking at 2027 and we're going to see the same problem persisting because, as you've just laid out, there doesn't seem to be an agreement one side or the other, whether it's more spending or more taxation or whatever it is. But everybody's waiting for that moment, and we need to get to that moment maybe earlier than 2027.
Yeah, the air is more rare at Élysée Palace and the oxygen is a bit lacking. But, you know, you don't have an immediate solution with a presidential election because president is something, but parliament is something else. Usually, we consider that the parliament will go the same color because the election are after the presidential election, so it will go the same color than the president. But it's not for granted. The most important is that we have a clear majority with a plan and a program at the Assembly. And of course, that this majority is a pro-business majority because that's the best way to go out of this situation. Of course, you know this. All your viewers know this. It's to create growth that will help us to go out from this. And that's why it's a bit, for people that are in the business in France, it's highly frustrating to see that somehow we come back to the recipe of the 80s, of the socialists from the 80s. It's never worked. It did not work in France. It's never worked somewhere else. So why are we doing that? Yep. And we need to fight because it's a constant fight to explain our argument. Every generation needs to do it, to explain all this.
All right, Fabrice Lessaché, the Vice President of MEDEF, thank you for joining us on the latest out of Paris. Well, switching topics and going to Israel, the government has approved a deal for Hamas to release its remaining hostages in Gaza in exchange for more than 2,000 prisoners and detainees. President Trump's son-in-law, Jared Kushner, attended the meeting along with Middle East envoy Steve Witkoff, in a move apparently meant to ensure that any holdouts wouldn't upend Netanyahu's plan to get a sign-off on the deal. President Trump says he'll travel to Israel to be on hand for the release of the hostages.
Peace in the Middle East. We secured the release of all of the remaining hostages, and they should be released on Monday or Tuesday. Getting them is a complicated process. I'd rather not tell you what they have to do to get them. There are places you don't want to be, but we are getting the hostages back on Tuesday, Monday or Tuesday. And that'll be a day of joy. I'm going to try and make a trip over. We're going to try and get over there.
Bloomberg's Horizons Middle East and Africa anchor Joumanna Bercetche joins us now. Jou, walk us through the latest now that the ceasefire has gone into effect.
That's right, Val. The ceasefire has gone into effect. Per the Prime Minister's office yesterday, they were waiting for the cabinet to actually vote on phase one of the deal before the ceasefire could go into effect. It passed yesterday, and also you may have noticed in those images quite a remarkable situation. You had the Israeli Prime Minister flanked on both sides by Jared Kushner on one hand, next to him Steve Witkoff. They actually were present in the room when the vote was taking place, and it's just another demonstration of how much diplomatic weight and clout the U.S. are pushing to get this peace deal agreed to. It is still phase one. Just to go over what that means, essentially, within the next 24 hours, it would require the IDF, Israeli forces, to withdraw back to a predefined line, that is the yellow line. It would still mean they'd have just a little over 50% of control of the Gaza Strip. But then subsequently, in the 72 hours after that, it would also mean that Hamas would then have to release the 20 remaining living hostages alongside the remains of the deceased. It's thought to be about 28, in exchange for up to 2,000 Palestinian political prisoners and detainees. And I should mention that that has been a very contentious topic and was one of the reasons why the negotiations went on for so long, because Israel had to actually agree to some of the names of the Palestinian prisoners that will be released. Some of them were serving life sentences. So this is the first part of it. The ceasefire has gone into effect. President Trump is saying that he's coming to the region, will most likely be there throughout the course of this weekend. Monday is likely the day when the hostages will be released. He's also floated the possibility of traveling to Egypt as well. We're waiting to hear the final details of his trip. But it should be said that this is again, still phase one. And the difficult matter now is moving on to away from this temporary ceasefire to a more permanent ceasefire that would entail the full demilitarization of Hamas, the full withdrawal of Israeli troops, and again, ultimately, to talk about future governance and reconstruction of Gaza.
Joanna, we're going to leave it there. Thank you very much indeed. Joanna Basecci, Horizons Middle East and Africa anchor, joining us out of the Gulf. Coming up, signs emerging that the worst may be over for the UK labour market. We'll get the latest from the recruitment companies reporting, plus also your other stocks you want to be watching this Friday morning. That's next. This is Bloomberg.
11 minutes to go to the opening trade across Europe here. We are looking a bit mixed when it comes to the equity picture. Euro Stoxx 50 futures in the green, but just slightly. Some underperformance in the FTSE at the moment. Over on Wall Street, though, S&P 500 futures are in the green, as well as NASDAQ. But joining us now is Paul Dobson, our executive editor for Asia Markets. Paul, I want to start off with this redhead that crossed the terminal just 10 minutes ago about the yen on the move because of a report that perhaps the ruling coalition in Japan could fall apart. Your thoughts on that?
Yeah, hi there, Valerie. So it's an interesting one. We don't know all the details yet, but the idea that the ruling LDP won't get the support of its coalition parties leaves it looking pretty vulnerable, and certainly opens up a rather uncertain path ahead for Japan. You know, there's still a possibility that Takaichi could continue to rule over a minority government. That would probably be more difficult then for her to get things through that she wants to get done. So it might reduce Japanese ability to do stimulus spending, therefore weigh on stocks a little bit. It might, you know, kind of take away some of her powers. And the market had been assuming that she was very bearish for the yen. We saw a little bit of strength come through immediately after the headline as a result that maybe, you know, kind of that won't be able to have the same impact. But we might get other scenarios. Maybe the other coalitions in a wildcard sort of scenario could try to form a government without LDP. That would create a lot more uncertainty. I don't know if the market would know how to trade that necessarily, and so it would probably be taken as a negative, at least for equities. But I think what's interesting here as well is, you know, we've been writing earlier in the week, the yen hasn't been looking very much like a haven or performing like a haven in recent days and weeks. So if there is more risk-off and uncertainty for Japan itself, does that mean a stronger yen, which you would have normally expected in the past, or may it actually weaken the currency instead, which would be a really interesting development?
I think the Swiss are watching this very carefully right now. Paul, I want to talk about emerging markets from a number of different angles, one of which is the fact that we've got this kind of dollar momentum trade, which is beginning to build a little bit of ground at the moment. And that kind of speaks negatively maybe to the idea that emerging markets are going to do well going forward, which has been a lot of a conversation people have been having. The other one is like the US is intervening in Argentina, which again kind of just raises hairs on the back of your neck about kind of Argentinian risk, EM risk. Are the stars kind of disaligning now for that EM trade?
It's a really difficult one to tease out. Emerging markets have been having such a great year. Emerging market stocks are up every month of this year, 9 months in a row, which is the longest winning streak since 2004. So they've got a lot of momentum behind them. But part of that premise, as you were saying, Guy, is the idea that the dollar is weakening. People are putting their money elsewhere. The currencies of emerging markets can fare well against the dollar when the Fed is cutting interest rates. So the fact that we are seeing this kind of bottoming out of the dollar and a little bit of a turnaround in some areas, you know, does jolt that confidence a little bit. Now, Latin America has already been performing better than the dollar, even when we've seen a little bit of this recovery. So it's not certain that that's going to impact there particularly. But this is, you know, like where we've got that really interesting thing. And the swap going on with Argentine pesos, the efforts by the US to support Milei and his government to help him through local midterm elections that are coming up and keep him in power feels like a political play as well as an economic play. But Argentina has defaulted so many times, they think the best way to prevent that happening again is to prop it up this time.
Paul, nice. A lot to get in there. Well done. Paul Dobson, Executive Editor for Asia Markets. Of course, you can follow the MLive team. MLive Go is the function on your terminal. It's got to be a daily read. hourly read. Let's talk about what is happening as we run up to the market open. 7 minutes to go until Europe cash opening. Chloe Melley's got some of the details of the stocks we want to be watching.
Good morning, guys. Let's keep an eye on UK recruiters today after new data shows that the UK labour market is stabilising. So UK employers did scale back hiring in September, but they did it at the softest pace in a year in September. So we could see that give a little bit of a boost across that sector this morning. As we can see, all of those recruitment companies have been having quite a tough year so far. It is worth noting that this is an improvement, but not necessarily a full-fledged rebound, and there needs to be a sort of shot of confidence in the economy to get this kind of full-fledged recovery happening and get that labour market going again. So let's keep an eye on that today. Of course, the next catalyst is going to be that November budget, so we'll keep an eye on that. Moving on to German semiconductors, that might be weaker today after Germany said that it plans to scale back funding for the chip-making industry by 3 billion euros and spend that money instead on upgrading its aging infrastructure. So we could see that reflected in some weakness for Siltronic, which has already been underperforming that EU semiconductor broader index, as well as Infineon, which has been doing better, but as we can see, has also started to stall and fall a little bit there. So we'll see how much that funding setback really changes this picture at the open. And finally, let's talk about consumer staples after a new JP Morgan note on the sector placed Danone on a positive catalyst watch and Nestle and Pernod Ricard on a negative catalyst watch. So, of course, there's already been a divergence in performance there. We'll see if that gap continues to widen on the back of this.
Chloe, thank you very much indeed. A couple of other things I'd throw into the mix. Keep an eye on the miners today. Copper's a little lower. Gold also on the move as well. Keep an eye on what is happening with fast fashion. That's going to be a story as well as we work our way after the into this market after the Uniqlo numbers. 5 minutes to go. The countdown to the open is very much on. Looks like it could be a busy Friday session. This is Bloomberg. It has been a wild week. There is a lot of things going on at the moment. You've got to factor in what is going on with the momentum trade. You've got to talk about what's happening in FX, the First Brand story, what is happening with politics, Japan. There's so much to fold in. In some ways, you could have argued we could have had a much more volatile week. We haven't had it yet, but is it coming? Yesterday, we saw a little bit of a roll-off in the European session towards the back end. We finished at session lows. We popped a little bit off that in the United States, so you may get a tiny turn off the back of that into European futures. So let's just see where we are this morning. But there are a number of other factors you need to fold into what you're seeing in these numbers this morning. The FTSE's down by 0.2%. Yesterday was a bad day for the banks. I wonder whether we are going to keep an eye on what's happening with the mining stocks today. I think that could be really interesting. You're starting to see some wobbles in gold. You're certainly seeing some wobbles in copper this morning. Is that a story that you need to focus on? The data coming out of China actually post-Gold Week is not looking that good. CAC 40 futures, though, are a little bit positive this morning, but overall, we are flat as a pancake in terms of the overall narrative, in terms of what we are seeing with Europe. Looking for a catalyst, and there are so many out there. Which one is going to prove dominant, Val?
Well, let's see if we get any single stock catalysts at the beginning of opening a trade. There are a few stocks and a few sectors we will have our eye on. One of them is retail, in particular fast fashion, the likes of H&M and Inditex. This comes after some pretty disappointing Uniqlo numbers overnight, so watch out for the fast fashion and the retail names. Also, miners pull back in gold. We'll be watching as well whether the FTSE 100 stays vulnerable to moves in mining stocks. And then lastly, chip stocks. We've had some news that the Germans have decided to fund roads instead of chips. So we're looking for some weakness perhaps in ASML today.
Okay. We'll see whether or not that story turns around for the chip sector. We'll watch that at the open. Here we go. It is time for the opening trade this Friday morning. There is a lot going on and a lot to fold in. Does it all cancel itself out and deal a kind of fairly neutral hand? Maybe that's what we see here. The FTSE 100 is down a little bit. We're down by 0.2%. We'll wait for the other markets to open up before we get a solid reading on the stock 600. The CAC 40 is going to be interesting this morning. What is happening in terms of the taxation story? The socialist socialists take over that prime minister role in France. We'll watch that one. The IBEX is up by 0.2%. Not much read there, but watch the fast fashion story, as Val says, into names like H&M and Inditex today. That's going to be an interesting trade to watch out for. The DAX and the SMI, we're going to wait, we're going to watch, we're going to see what happens with those markets. They could take a little while to get going. Yesterday, a huge session for the German auto sector, the Italian auto sector as well. Do we see some recovery in that space today in the German market? We'll wait and we'll find out in just a few seconds. Valerie, sectors, single stocks, what are we seeing?
Well, when it comes to the sectors, the one that jumps out to me is we are seeing a slight recovery when it comes to the auto sector. It had one of its worst sessions in a while, with Ferrari shares yesterday dropping the most in nearly a decade. So they are recovering in the first moments of today's trade. So we have autos at the top. We also have retail at the top. So it does seem like Uniqlo isn't posing a negative catalyst for European stocks at the moment. We have H&M actually in the green, up 0.7%, but one we will continue to monitor. At the bottom of the basket, we do have basic resources, so that turnaround in copper is weighing on some of the minor names. I see Antofagasta dropping more than 2%. That is dragging down the basic resources sector. Also at the bottom of the basket, we have energy and healthcare. So some of perhaps the pullback in oil prices on the back of this breakthrough of the peace plan from Gaza having some negative effect when it comes to Shell, Total Energies, and the likes of BNP.
Okay. So in terms of some of the movers this morning, we are seeing maybe that gold story, that copper story rolling into the market. You can certainly see that in names like Glencore, Rio rolling off a little bit. It's interesting to see the market feels a little bit more defensive this morning. It's always fascinating when you have names like Anheuser-Busch, Unilever and Diageo at the top of the market. Feels like a safe place to hang out, maybe the beer market and the toothpaste market and the deodorant market. That feels like a kind of safe place, maybe, to be in a world that has been driven by AI trades.
Yeah, if you're worried about a bubble, you hang out in things like toasters and people that make kettles, right? Is that what we learned? But yeah, let's broaden this conversation out. We do have a guest around the table. Hugh Jimber from JP Morgan Asset Management is joining us this morning to discuss this and more. Hugh, I see that you are still bullish. You want to stay pro-risk. You want to stay invested. What are the risks on the horizon on your plates?
Well, good morning. I think you do have to stay invested here, because ultimately the big drivers of markets are monetary policy turning more supportive, number one, and fiscal policy still booming. So when you have more fuel being added to the fire, clearly this is going to be a difficult time to fight stock markets going further. But for me, this all hinges around inflation, because the story that keeps this all together is this benign assumption that US inflation is going to remain at low enough levels to keep the Fed being able to cut, and importantly, to avoid any questions around Fed independence, to justify Fed cuts via their concerns around the labour market being greater than their concerns around inflation. So that's an area we're spending a huge amount of time. Good news, hopefully, overnight, that we're going to get some more data on US CPI in the middle of next week as some of the government statisticians return. But inflation, I think, is the key metric in Q4, because we know the goods price pass-through from tariffs has been slow so far, but we are expecting that to show up more and more clearly as we move towards Christmas.
How are you feeling, though, about the broadening of this rally? I got some stats from our own Daniel Curtis saying that there's only 3 S&P sectors that are up this month. Tech, the obvious one, healthcare and utilities. The other remaining sectors are in the red. Does that concern you about this bull market here?
Well, I think it makes sense in the context of what AI is doing for the US economy. So there was a very popular trade coming into 2025 where many were saying you need to look away from the Magnificent Seven and the US mega caps, and you need to anticipate this broadening out of earnings that should then benefit a much wider range of stocks in the US. Have we seen that in the earnings data so far this year? No, not really. And as you look ahead into the forecast for 2026, you've got the Mag 7 cooling earnings growth towards something around 15% year over year. But for me, the bigger question here is, can you really expect to see the rest of the S&P 500 also delivering mid-teens in earnings growth? Because that, for that group, is very unusual. And AI is driving economic growth. We've had tech spend really contributing more to US growth this year than the US consumer. If that falters, you'd expect broader economic growth to falter, and that's going to put more pressure further down the S&P 500.
Yeah, there was some data from a Harvard economist that I was reading yesterday from Jason Furman that said if you stripped out all the data center investment, first half GDP for the US is not 0.1%.
Exactly. So this is where I think if you're looking to diversify away from the AI trade, shuffling around your US allocation no longer really works because we know the 493, particularly US small caps, which have had a good run over the summer, but they're much more closely geared into what you're seeing in the US economy. So this, for me, is where regions like Europe and particularly the UK start to get more interesting because you have different economic drivers and fundamentally you just have a much, much lower exposure to the tech names, which for 10 years has been a big problem, but is starting to look like a much more attractive characteristic again.
Are European politics going to get in the way of that trade? Right, we've got a budget coming up, could be problematic here in the UK. French politics, we all know what's happening there. Is that a problem?
I don't think it is for the large caps. Take the UK as an example.
Yep.
The FTSE 100, I think, can look through most of what we see in the budget, and particularly if that budget leads you to a weaker pound because of weaker growth prospects for next year, that is categorically a positive for UK large caps. So we can debate the macro, we can debate what it means for the gilt market, for the OAT market, where clearly there are more challenges. But for the large caps, and indeed in France, you've got a market which has very little to do with the French economy, in truth. So politics, I think, is preventing some international investors from coming back to the region. But ultimately, what's driving these stock markets is the composition, the sectoral composition, and not the domestic politics.
If the US tech trade falters, isn't there just going to be a markdown of everything? And kind of, how do I deal... These conversations are relative or absolutes. Are you saying this is a relatively good trade? The UK and the Europe is a relatively good trade or an absolutely good trade? If the US rolls over, what is the beta into Europe?
Yeah, so let's take the UK as an example here. The relative argument is a much easier one to make. Sure. Let's be clear. You know, if the tech trade falters, clearly the FTSE 100, it's a defensive market, trades typically with a much lower beta to global markets than anywhere else, and so your confidence is primarily a relative story. In terms of the absolute, I guess the question here is, does this M&A wave that we're seeing in the UK actually put a floor under valuations? Because we're seeing repeatedly this year more and more international buyers coming in for UK companies, and on average, they're doing those deals at about a 40% premium to the share price before those deals are announced. And so that, for me, does give you an interesting angle on the UK specifically, because clearly tech stocks coming under pressure, the US market coming under pressure is going to create headwinds globally for valuations. But I think what's more interesting about the UK is if we can be confident in the floor on where those valuations are going, given the appetite from both international investors and indeed buybacks, it starts to make the case for maybe not so negative an absolute story as well.
Hugh, you wrote that you expect further yield curve steepening to be in effect. What could possibly dent a kind of call like that? I do think that steepeners are still a popular trade. Perhaps maybe something ripe for a sharp unwind if we get upset.
Yeah, I do find it hard to see because this is a market where fiscal concerns are coming to the fore. Now, those fiscal concerns are rotating around the world. I think the bond market likes to focus on one country at a time. Today, it's France. You know, this week, it's been France and Japan. Maybe it's the UK in a few weeks' time as we move towards the November budget. But ultimately, investors, I think, are absolutely right here to be demanding more compensation for risk. So how would you get that out? Well, at the front end, maybe you need the Fed to start to think a bit more about its inflation mandate and less about its labour market. So you see the Fed really trying to get a grip again of inflation and tackle the problem that's building. But how likely is that in a world where we know that central banks everywhere are really backing off how seriously they take a 2% target and thinking much more about the health of the overall economy rather than a kind of singular view on controlling inflation? I don't see that as likely anytime soon, with central banks waking up one morning and saying, well, we've lived with inflation above target for 3 years, but today the time is now to really tackle that. I find that hard to see.
So in some way, this is causing permanent damage to central bank inflation targeting. The fact that they've let inflation stay above target for so long, people aren't going to believe they're ever going to be serious about it ever again.
Well, let's question what their target really is, right? Are they implicitly accepting here that a 3% inflation target is absolutely fine? And to be honest, You know, what would be the problem with a higher inflation target? If you're willing to run economies hot, we learned back in the 2010s that 2% was chosen as the level where we thought we'd never have to go to negative interest rates. We'd never have to mess around with QE, and yet where did we get to? So I don't see really a big problem with moving an inflation target higher. I think the difficulty today is, can you move that inflation target when inflation is already above 2%? Or do you have to wait for the next global macro shock, the next big recession, ultimately, that does take inflation down, and then is that your opportunity to open up the discussion about inflation targets moving higher?
If Scott Besson's watching, take some notes and think about what we're talking about. Final quick question. Emerging markets. It's been a great run this year. Feels like investors are just waking up to that trade. Are they too late?
I don't think they are, but I think you have to be very careful about what you're trying to get exposure to. So the tech story is, for me, the most interesting here. All of what we're hearing between the US and China is about two super powerful economies trying to grow their independent tech infrastructure, because this is an issue of national security. So Chinese policy support has turned, and just look at the back and forth that we're getting on chips at the moment. The US passing a ruling overnight to say US companies have to have first bite at the apple in getting their hands on US chips. At the same time, the Chinese are saying, well, maybe we don't want those US chips because we want our companies to be dependent on domestic infrastructure.
As a result.
Exactly. So with that, I think you do need a foot in both camps, because this is no longer a zero-sum game. These are two tech supply chains that are serving very different demand centres. Where we're still a little more hesitant is around the domestic Chinese consumer backdrop, where consumer confidence is fragile, the labour market is still pretty weak, and so I think your case for an EM allocation today looks quite different to a few years ago, where it was all about the emerging consumer and upgrading purchasing preferences and increased purchasing power. Today, I think it's more about the tech story.
Great to see you, Hugh. Covered a lot of ground this morning. It was great. Hugh Gibber, Global Market Strategist, joining us from JP Morgan Asset Management. Course 6 looks a little bit like this morning. Let's check out what is happening at the centre of gravity here in Europe. Defence unchanged. ASML soft. You are seeing actually some of the pharma stocks coming under pressure as well. We're hiding out in maybe some of the staples. Nestle up by 0.2%. The luxury stock sector coming back a little bit. The car sector's had a bumpy ride this week. You are definitely in need of an update on that front. Let's get that right now with Chloe Mellet.
Good morning, guys. So let's start with a positive movement for a car maker this morning. Sorry, Stellantis said that its third quarter deliveries jumped 13%, and that was due to a really strong performance in North America specifically. So this really points to recovery in that market. We heard from Stellantis recently about wanting to refocus, reinvest in that US market that it had abandoned a little bit. And it seems that that recovery is coming through, and we see the shares up this morning 1.5% on the back of this. Moving on to the mining sector that is seeing a little bit of weakness this morning on the back of a pullback in gold and in copper. We see in particular Fresnillo, which had really benefited from this rise in gold, this gold hitting a record, and now that pullback is driving down the shares. We are down 3.8% for Fresnillo this morning, and downward movements across those other mining names as well this morning. Moving on to Energy Contour. So this is a smaller company over in Germany. It makes it operates windmills, operates solar sites as well, and it is down after cutting its 2025 forecast. It is down 13.4%, so massive downward movement there for that company. It really points to weakness across the renewable energy sector. And finally, let's move over to France, where Technip Energies, which is a engineering and technology company, was downgraded to a neutral rating at BNPP, and that is also driving down the shares quite a bit. We are down 6.7% for this company.
Chloe Mellet from our equities team, thank you. Coming up on this show, a blistering run in global equities has faltered amidst rising concerns that technology valuations have run too far. We'll have more on this next. This is Bloomberg.
17 minutes, 18 minutes into the equity market session. We're fairly quiet at an index level, though we are seeing green on the screen across much of Europe this morning. Not much, though. And actually, the sector story is more interesting. We'll come into the sector story in more detail in just a moment. I just want to do a bit of breaking news for just a moment. China, in some ways, mirroring what we've seen in the United States, announcing in the last couple of minutes that it is going to impose special port fees on US vessels from October the 14th. 1,120 yuan per ton on US vessels will be imposed. Remember, this all comes ahead of this US-China summit, which may happen, may not happen. We think it's going to happen in a few weeks' time, but it's also worth adding in overnight. We've seen China talking about chip restrictions. We've seen the US talking about chip restrictions. So we're very much focused on what is happening in that landscape as well. But we're now imposing special port fees in China on US vessels.
Well, let's broaden this out to a discussion. As you mentioned, we have tech also on our mind when we're thinking about the negotiations between the U.S. and China. It's on our mind as well for this AI trade as it continues to heat up. We are seeing, though, a bit of weakness when it comes to European chip names this morning. ASML down 0.9%, really dragging down the Eurostock 600 today. But over in the U.S., it has been a fairly positive week for the NASDAQ, up 1.3% in the last 5 sessions when it comes to those NASDAQ futures. We did wobble a bit in yesterday's session, and there were maybe some panic about whether the correction is finally here. But let's talk Bloomberg. Let's talk with Bloomberg's Tech Europe anchor, Tom McKenzie, on this subject. Are we ripe for a correction when it comes to these tech stocks? I think that is on the mind of most market participants.
It does seem to be on people's minds. What you've seen, though, in the last year or so, more than that, is that every time there is a drop in these tech stocks, it's just an opportunity for people and investors to add exposure. Look, the run-up's been there, the spend is huge, the numbers are there. But as others have pointed out, the balance sheets of the hyperscalers who are doing a lot of this spend and a lot of this commitments, they're pretty solid as well. They have their own revenues. Yes, there's the mismatch between the capex spend and the revenues at the end of this. But for now, standing in front of this train is something that most investors seem to think is too big a risk. So if you do see a correction, and there's been a softness, it was a challenging session in Hong Kong. The tech stocks in Hong Kong, the Chinese-listed names in Hong Kong took a fairly sizable hit. And so there's that sentiment is filtering through to Asia as well, which is interesting. UBS putting out a note. This is coming from their global head of equities. The AI trade is not without its risks, but we see compelling reasons to stay engaged because of the fundamentals, accelerating adoption, and the favourable macro environment.
It's interesting. We were talking about this with one of our previous guests, talking about the fact that we've shifted from cash flow funding to debt funding. And that's the kind of the moment that people are beginning to kind of think, actually, is this bubble going to be sustained? Is it all getting a bit circular? Is it now fueled by debt? Kind of when all that unwinds, therefore, once you put the debt into the mix, you have to mark it down. Things get a little bit more aggressive on the downside. You've had a really interesting few days talking to bank CEOs, and not just any bank CEOs. We're talking Goldman Sachs, we're talking JP Morgan here about the impact that AI is going to have.
And one of the key lines came from JP Morgan's Jamie Dimon himself, who said, they invest about $20 billion on tech every year, about $2 billion specifically on generative AI, of which they get revenues of about $2 billion. He expects that dynamic to shift positive in terms of revenue. So they're seeing real change as a result of that. But we also, of course, spend a lot of time talking to all these CEOs at Goldman, at JP Morgan, and of Klarna, newly listed on New York as well, about the impact that AI is having on jobs and the banking space there. And they all said, yes, jobs will be affected, but with slightly different nuances. Take a listen to what Sebastian Siemiatkowski, the CEO of Klarna, had to say about that.
It comes back to the vision that we had at Klarna 10 years ago, which was very basic. It said, in the future, there will be a digital financial assistant. It will analyze your spending. So to us, this was basically where we believe retail banking was heading. And a little bit like self-driving cars, don't know when, but know that it will happen. And that's the future. And it has profound impact and consequences for the banking industry.
OK, the CEO of Klarna, Sebastian Siemiatkowski there, talking about his vision to have a position in 5 or 10 years' time where Klarna is an AI superpowered app that can address all of your financial needs. He has a vision where he's sitting there alongside the likes of Revolut. Goldman Sachs will still be there, he says. JP Morgan will still be there. That ultimately, he says, in 10 years' time, there'll be 5 major banks. There can be a major consolidation result of this. He'll be up there with Klarna, Revolut, Goldman Sachs and JP Morgan. JP Morgan, by the way, top of the list on one index in terms of companies and banks specifically, that are adopting AI. For the second year in a row, JP Morgan is at that top of that list. Klarna wants to play a role.
Okay, but Tom, to deliver that kind of those AI apps, you need the data centers, you need the computing capacity, and we just had a warning from Microsoft, Bloomberg Learning, that they're saying that the data center crunch could last well into 2026.
This ties into the bull case then for the spend on AI and some of the upside that you're seeing. Microsoft's challenge is not a lack of customers, it's not a lack of demand, it's actually meeting their customers to the point where the Azure cloud, which is the big profit driver for Microsoft, $75 billion US, now into 2026, first half to 2026, some of their customers, some of their additional subscriptions, they won't be able to actually online into the first half of 2026 because they do not have enough data centers to serve traditional computing needs, but also the AI.
Okay, so where's the revenue from the AI? Where's the revenue going to come from?
How are they going to make the money to pay for all of this if they don't have the computing capacity?
But this comes back into the debt story. But it's all going to get debt funded because the revenue won't be there in order to do it out of cash. It gets very circular. Tom, thank you very much indeed. BTEC Europe, Tom McKenzie. BTEC Europe's Tom McKenzie. There we go. Got it right. It's been a bad week for the auto sector here in Europe. Did you see Ferrari yesterday? Let me just show you the 5-day. Let's run through some 5-day charts just to give you an idea of what's been happening. Let's start with Ferrari because that was pretty ugly, as you can see. Fine. Very ugly, very quickly. Porsche 5-day. Let's just show you that one. That kind of gets uglier faster, but still pretty ugly. BMW, let's show you what BMW looks like, just to give you a kind of sense of what's happened there. These are big losses. Craig Trudell, our global auto editor, has had quite the week. It all suddenly seems to have gone wrong. I say that. It's been getting bad for a while, but this week has been bad.
Well, I do think this is a unique week because I would put Ferrari and BMW sort of in the camp of the companies that were sort of flying high and sort of keeping above the rest. We've seen Porsche for some months now really struggle. We've seen Volkswagen, Stellantis, Renault. These companies have real issues. I think Ferrari was a high flyer and has been a high flyer for years. BMW, I think, is sort of widely regarded as the best executor in the German car industry. And to see these companies really sort of fall flat on their face this week, it is a sort of further indication of just how tough it is in terms of the sledding for this industry.
Well, a tough market for EVs. We're seeing these companies pull back on their EV pledges, but at the same time, we've had the German government pledging aid to help Germans essentially purchase EVs.
Yeah, absolutely. And I think that's important, particularly for the sort of larger volume manufacturers. I think, look, Ferrari's going to be fine. I think part of the reason that the stock fell so much is it's been, rising so much for so many years. Chris Bryant had a great Bloomberg opinion column yesterday about just the incredible amount of inflation in Ferrari vehicles, and at some point you had to wonder, how much are even consumers who are buying Ferraris going to take that?
But his piece is really interesting because it talks about resale values as well. Because if you buy a Ferrari now, not that I've had this experience, but basically you customize it quite heavily.
Absolutely.
The problem is though that if I'm buying a used Ferrari, I don't want somebody else's customization, so the value of that customization goes down really fast.
Very quickly, yeah. And I think, to tie this back to the sort of broader industry, though, I do think, even Porsche, apparently needs some help incentivizing its customers to go electric. And that's not to say that the sort of, broader industry that employs a lot of people, where the need for affordability is so much greater. I think that's where these incentives come in, where we're going to need this for the number of jobs that we have.
Great to see you, Craig. What a week. Craig Trudell. Coming up, we've got much more to talk about. We're going to be talking about auto parts suppliers. Friday the 10th. Good morning. How are you doing? European equity markets a little bit calm this morning, so you probably got a chance to sit back and take a look at what the landscape looks like, maybe from a broader perspective. European equities aren't doing anything. Stock 600 up less than 1/10%. DAX is up a little bit more. Autos are bouncing back. CAC 40's a little bit stable this morning, more stable this morning. Luxury names are on the front foot. Miners are not, so that's dragging a little bit on what we're seeing in the London market. So just look at that 1/10% now on the FTSE 100 and probably ascribe it to what is happening with the gold story and the copper story and everything else. In terms of the market internals, quick look at what is happening. As I say, it is a Friday, so just bear that in mind as well. 385 up, 202, 200 down. Volume's a little light. As I say, it is a Friday. 52-week highs, 52-week lows. I've got a few highs for you. Nordex is the one that actually stands out to me in this board here. NL as well to a certain extent, but Nordex here up by 0.2% at a 52-week high. You're actually seeing a little bit of momentum maybe coming back into the renewable sector. I know it's been under a pretty big cloud over recent weeks as a result of what's been happening in the United States. But it's interesting that actually Nordex has climbed that and is now up by 0.2% this morning, Val, at a 52-week high.
Well, here's what else you need to know this morning. President Trump says he'll travel to the Middle East after the Israeli government approved a deal for Hamas to release its remaining hostages in Gaza in exchange for more than 2,000 prisoners and detainees. The French president is expected to name the next prime minister this evening in an attempt to form a new coalition. This is after the resignation of Sébastien Lecornu. Bloomberg understands some business leaders attended a dinner last night with the head of the Socialist Party, which is seen as the kingmaker. The party wants a left-wing premier open to agenda changes, such as the suspension of pension reforms. And finally, Japan's ruling coalition has collapsed, according to the leader of Komeito, the junior party to Takaichi's Liberal Democratic Party. This is after the two sides failed to overcome their differences on political funding regulation. Guy?
OK, let's turn our attention to what has been happening in private markets this week. The Financial Times is reporting the US Department of Justice has opened an inquiry into the collapse of First Brands Group. Separately, US court documents have revealed a joint venture between Norinchukin Bank and the Japanese trading house Mitsui faces a $1.75 billion exposure to the bankrupt auto parts supplier. We're also learning this morning that potentially you're seeing some of the European insurers on the hook potentially around claims relating to this story. James Reynolds, Global Co-Head of Private Credit at Goldman Sachs Asset Management, joining us around the table. Good morning.
Good morning.
So here we go. Here's kind of one of the first major blow-ups we're seeing in private credit rippling through markets, and the effects are quite substantial. US banks have been caught up in this, insurers have been caught up in this, Japanese banks have been caught up. It reaches out into lots of parts of the world. Would you expect this to change the nature of private markets and this incredible run that we've seen as money has poured into this space? Is this something that you think changes the tone more broadly?
Look, we remain very constructive about private markets in general and private credit in particular. By the way, we have been in this market for almost 30 years, right? So we have seen, cycles on the up, on the down. So I don't think it changes the direction of travel and the interest for private markets, private credit in particular.
Yep.
Now, I think if you step back, look, what are the two key pillars of private credit and performance in credit? It's discipline, right?
Yeah.
And it's underwriting and credit selection.
Yeah.
And I think, by the way, in general, on the private sides, you have differentiated access to information. So I don't think there's going to be less interest. I think, though, what you're likely to see in the coming years is, for the first time since the GFC, is dispersion in performance across managers.
OK. And that's going to become because some haven't done their due diligence, basically.
I think some managers may not have had the experience of prior cycles.
Yeah.
Some managers may not have, the origination edge that, others may have to effectively find those good assets. Some may not have, the scale nor maybe the teams to navigate challenges.
There were 30% interest rates being offered here on vendor financing. That screams to me that somebody wasn't paying attention to risk. That's what is going to make people worried. The obvious signals were ignored in this desperate rush to put to work serious quantities of money that are piling into this sector.
Yeah, look, I'm not going to be drawn into a specific deal, but if I look at what we're doing in private credit, and clearly for the last 28 years, we indexed our business towards defensive stories, defensive sectors, stable, recession resilient. The alpha in our business is almost solely related to minimizing defaults and avoiding those losses. That's it.
I want to turn maybe our focus into how private credit is going to play a role in data center funding in this AI frenzy. In some ways, I want to ask you, how big can some of these private credit deals get? Because the gap for funding, we get new numbers every week, it feels like, but there's a $1 trillion that needs to be raised in order to finance all of this pledged infrastructure spending. How do you expect private credit to play a role in that?
That's true, and here we're probably moving towards more the private investment grades, right, which is a big trend. It's a trend that started several years ago, almost a decade ago. It's led in particular by insurance companies trying to pivot from public to private to get a bit of a premium compared to what they otherwise would get in a public portfolio. So we're seeing that. We're very active in that space. We're working very well with our investment bankers, actually, very active in that space. Look, this is likely to continue, and not just data center financing, but also anything that has to do with, I would say, powering the data center, energy transition. And so we're very active in that space as well. You're right. I mean, the numbers are large, and so it will require sound underwriting, sound structuring, having the right collateral, the right counterpart, contractual agreements as well, so that you have attractive offtake agreements. And then I think, a lot of the insurance companies or pension funds or even sovereign wealth funds today are really kind of pivoting towards kind of private investment grade or structured investment grades. And I think that's likely to continue for a few more years, decades maybe.
And when it comes to financing some of these specific deals, I guess what can private credit offer some of these infrastructure companies that maybe, tapping the public markets can't? We saw Oracle tap that large bond deal. I guess, what's the pitch from private credit on why they should look into private financing?
Customized structure, bespoke financing, no need for a rating. You can really sit down with the management teams and provide a very kind of bespoke structure that otherwise the market would not be able to provide, because the market and the banks underwriting for the market are going to have to go for fairly standard financing. And so that's the power of private credit, and that's why we remain very constructive about the outlook. Yeah. There's a place for private credit.
But do you think that, to Val's point, there's an awful lot of money going to be required as we switch from cash flow financing to debt financing? There is this gold rush mentality that is there at the moment. And we started this conversation talking about due diligence. Is there just this... What vibe do you pick up from the market about this kind of headlong rush into financing data centers? When you listen to people in the technology sector, they say some of this stuff isn't going to work. A lot of this stuff isn't going to work. How good can the due diligence be at this point?
Well, I go back to the basics, right? I mean, it's getting access to information. It's about not having the FOMO, a little bit what you're describing here. Yeah. It's about, and it helps when you've actually been through cycles, right? And I think that's what's going to make the difference. I go back also to the point I made earlier, which is you're going to start seeing dispersion in performance. We're already starting to see it. And I think investors, whether it's the insurance companies, pension funds, even wealth management or retail, will have to certainly be more discerning about the managers that they want to back.
James, I guess one of the perhaps issues with private credit is that maybe that private credit and private markets in general have only really ballooned because essentially regulation to do public financing has gotten too onerous. Are you seeing anything out of the Trump administration that could really have a catalyst for your business when it comes to this deregulation push across the banking sector?
No, I would say private credit has ballooned or increased because it offers a very unique proposition to the borrowers. That's the reason. We were doing private credit back in the late 90s, right? And the banks were still very active, holding on their balance sheets. It has a reason to exist. It provides, the benefits that I mentioned earlier. And it provides those benefits, by the way, at times when even the market is shut down, right? And so if you're now in the shoes of a management team and you can know your lender is going to be here almost in any market, and his long-term and patient capital. I mean, these are the reasons why private credit exists. And so whether it's in the US, in Europe, or increasingly in Asia, by the way, we're seeing a lot of interest for the sector.
If the Fed cuts rates aggressively, which is a possibility next year, would that be a headwind?
Look, we've operated in markets where we've had zero interest rates, and have delivered very strong returns during that decade. So is it a headwind? Yeah, it is a headwind to the extent that most of what we do is floating rates exposed. But I would say we've been able, in a decade where we had even negative rates in Europe, we've been able to deliver really attractive risk-adjusted returns.
Just to kind of wrap this all up, I just want to kind of get... we don't have to get to talk to kind of people who have got first-hand experience as to what is happening. The message you're delivering as the market's got really big, managers that are kind of tourists, can we call them tourists, have come into this space and they've not done the kind of the work that they need to, and as a result of which you need to be really careful on who your manager is at the moment, because the dispersions are going to go up. Can I just focus on that last point for a moment? How much do you think dispersion is going to... at the moment, the tide has gone up. Everybody's gained. As the tide starts to maybe kind of... we get to the top of the tide, how big is the dispersion going to get? How big is the difference between what you're doing and what another manager could be doing at this point?
I think the dispersion is likely to be very significant. And what's likely to happen, by the way, is that a lot of these platforms are unlikely to raise the next funds, right? I mean, when they go to LPs, to institutional LPs, it's going to be that more challenging to explain some of the mistakes made in previous portfolios, in past portfolios.
It's great to see you. Thanks for talking.
Thank you very much.
Come back anytime. Global co-head of private credit at Goldman Sachs Asset Management, James Reynolds. Coming up, we're going to head to Riga. Oliver Crook is getting ready to have a conversation with the ECB Governing Council member and Bank of Latvia Governor Martin Kazāks. We will bring you that conversation. And today, you can also watch the latest Leaders with Latcar, her conversation with Bridgewater Associates founder Ray Dalio. Got some interesting things to say about what is happening in the States. It's out on the Bloomberg website. It's on the terminal. You can catch it on Bloomberg TV, 5:30 p.m. in the UK. I just want to leave you with a little preview of what Ray has been discussing and talking about his controversial management style.
What I call it is tough love. It's tough love. Yeah. Let's say you have a player on a team, okay, and he's got an issue. Okay, are you going to let it go, or are you going to deal with it? If you're going to have an effective team, you have to deal with it, right? So I can't not deal with that.
But this is the concern with leadership, right? You also want that person to be confident, because as soon as you lose that confidence, then you no longer have a player that's any good.
Yes, but you see, the confidence I learned to get was by knowing my weaknesses, to gain the open-mindedness. Pain. Yeah. We don't like pain. But what happens is pain is a messenger. It tells you about how the world works, and it tells you how you should deal with the world to be effective.
How is that? I mean, how did you think about pay? Was it
I think about pay as a share in the mission. And if we're successful, then we should share that. If we're not successful, we'll go through the pain. Can we go through the pain together in order to get to be successful? If it's too transactional, you're going to have a problem, okay? I want people who will go through the ups and downs with me because we have a greater mission.
The latest account of the European Central Bank September meeting says officials considered another rate cut in September, but ultimately decided against it amid upside inflation risks. Oliver Crook is standing by with one of those ECB decision makers. Ollie?
That's absolutely right. Thanks so much, Valerie. We're here in Riga in the sidelines of the LATO conference here dealing with security, but also sort of financial prosperity within Europe. And I'm very pleased to be joined by the governor of the Bank of Latvia, Martin Kazāks. Thank you so much for your time today. Greatly appreciated.
Thanks for having me.
I'd like to begin, if we can, just on your view of where sort of rates are heading here in Europe. It seems that things are finally balanced. That seems to be the consensus view over at the ECB. Is there still an easing bias at the ECB, or could either the next rate move, even if it's in the distance, go in either direction?
In my view, we are about neutral, and I don't think there is any kind of bias at the moment necessary. We have delivered the target. We are at around 2%. Of course, there are going to be short-run deviations from 2%. There's going to be some volatility around it. The important thing is how large and persistent are those deviations, and what is the medium-term outlook. From the data that I have today, and from the inflation outlook that I have today, I think 2% policy rate is very appropriate. Of course, uncertainty is very high, and there are risks on both sides. Risks on the downside perhaps are more in the category known unknowns. For instance, the strength of the currency, the size of the Chinese dumping and push on the prices in terms of kind of lower inflation, also the ETS 2 in 27. But there are also quite a lot of unknown unknowns, and those are mainly geopolitical, and those, for instance, negative supply side shocks would push inflation up. So I think we are in a relatively neutral place. 2% is all right.
And have you seen any sort of quantifiable data from the Chinese potentially disinflationary pressure of dumping recently?
We see some trade flows improving, but increasing, and those pressures are gradually increasing. But of course, we still don't know exactly what the size of and scope of that is going to be, what's going to be the deflationary pressure from that. And of course, we don't know how European politicians would react against it.
And the French government seems to be collapsing every couple of weeks. What kind of risk does that pose?
Of course, we've seen some movements in terms of the spreads, but I don't see at the moment anything extraordinary. We've seen similar levels in the past. We have a wide set of instruments, but there is no need to, in my view at the moment, to discuss such issues. We are not in those kind of straits. But one of the issues that, of course, is the direct implication from political instability is the ability to perform and introduce structural reforms. Europe is in bad need of stronger growth and structural improvements. Single market, if we talk about finances, single market financial services, capital markets union or savings and investment union, whatever we call it, let's just take the, I would even call the Draghi's manual, okay, and implement it. It's going to be better.
And on some of those reforms, your colleague over at the Bundesbank has proposed a common European budget for defense, suggesting that could be financed by joint debt. Where do you stand on that?
By all means, yes. It would also be more efficient than doing it individually. The procurements, the fragmentation nationally, makes the process longer and more expensive. I think this is a common European necessity, and it would be a very cornerstone of European security. Yes, I would support it.
And another structural reform, some reporting out overnight that we're seeing that the Germans seem to have lifted their resistance to giving up some of their financial regulation within Germany and potentially willing to give that up to a broader European project. Do you think that the Capital Markets Union could finally be in sight, and what would the impact of that be?
We badly need that. The issue of Europe is that Europe is aging, but Europe is still rich. But we are playing a defensive strategy. And if you keep playing defensive strategy, at the time when technologies are changing rapidly, at the time when geopolitics are shifting, that, in my view, is the wrong strategy. We need to play offense. And that means stronger growth, better use of our financial means, and that means opening European market for single market benefits, which is still, in my view, lots of low-hanging fruit.
And one of the ways that policymakers are now discussing about playing a little bit more offense is talking about touching or monetizing in some way the frozen Russian assets that currently sit in Belgium. I'd like to understand from you what your perspective is on the possibility of monetizing those without, taking them. Is there a possible path to that, and will that endanger the euro?
I think there is a path to that, and in my view, there is a necessity because at the end of the day, the war in Ukraine is also with direct impact onto us, and it needs to be financed. And bluntly speaking, there are two choices. One is to tax our own societies. The other is to take the aggressors' money. And I think the second option, of course, is a better option. So I think there needs to be ways found how to employ those assets for defense of Ukraine much quicker and to a larger extent. Of course, law is law, but there's private property, of course, is of importance, but there is also private property in Ukraine that gets destroyed. There are human lives that get destroyed. So Ukraine is our ally, and we should help it, and we should find the ways that are most efficient and less costly.
And a final question about you, sir. Commerzbank has pronounced that you are one of the 4 oracles of the ECB, saying that you stand out throughout the entire observation period. Your assessment of the economy and inflation are very close to what the Council has, and as a result, you often draw the right conclusion with regards to interest rate decisions. Should there be a place for an oracle on the ECB's executive board where positions are opening up very soon?
Well, that was very pleasant evaluation of the work I've done so far, and I'm going to do the best I can going forward as well.
Can we say that your hat is in the ring for the executive board?
It's going to be for politicians to decide.
Well, Martin Kazāks, thank you so much for your time. Greatly appreciated. I'm speaking here at the sidelines of the Riga conference here in Riga, Latvia.
Oliver, thank you for that interview. Interesting that he did weigh in on the French political crisis, saying he's not seeing anything extraordinary in the French situation at the moment, but maybe that could heat up over the weekend. Remember, we do have Macron's self-imposed deadline to pick a new prime minister later this evening. But some other things on your agenda today at 10 a.m. UK time. We hear from the Nobel Peace Prize who their winner will be. That will be announced at 10 a.m. At 3 p.m., we have the UMich consumer sentiment. Remember, we have a lack of government data, so we are really hinging our hat on these other private surveys for a guide on the U.S. economy. And later tonight at 7 p.m., the federal budget balance for the month of September.
So this weekend, let's kind of think about what we're going to be doing this weekend. I think we're going to read a lot about France and French politics and whether or not actually the next Prime Minister has any chance. Japanese politics looks like it's suddenly inserted itself in quite a big way into the agenda as well. I think you're going to read a lot of articles this weekend about the bubble, no bubble, AI data center story. And then there's the Peace Prize.
And there was some Trump tweets about him being upset about it.
Well, yeah, the odds at the moment are not in his favour.
I think Polymarket had it at 8%.
Yeah, I think it may have crept up slightly, but yeah, 8% yesterday was the number. So that comes out fairly shortly. I think we're all going to be agog with anticipation watching that one. Next weekend for sport is amazing. So basically, this means that this weekend you're going to have a lot of time to read things, which is good because there's a lot of things to read. So the next weekend is fantastic for sport. This weekend, I think you got Denver versus New York. I think that's in London.
Yeah, NFL games in London, week 2 of 3.
I think you're going to be. I'm sure you're tuning in on that one. Massive football fan. Horse of the Year show. Is that high on your list of kind of? I think it's in the Midlands. It's up near Warwickshire, near Solihull or something. But anyway, Horse of the Year show.
And then in Paris, we have a 20-kilometer race, as well as the Prime Minister announcement. So maybe someone's running for the gates in political
Feels
ways.
Like a marathon. We've already run a marathon already, it seems. Maybe. And the London Film Festival is on as well. Anyway, as I say, politics is going to be fantastic this weekend to watch out for. There's great reading to be had. Bloomberg Weekend newsletter, definitely worth catching up on. Anyway, have a great weekend, folks. We'll see you Monday. Hope you enjoyed the show. This is Bloomberg.